There we go. If we can try we've got an agenda here, and then we've got several other committee meetings that we're trying to do this afternoon, so I appreciate everybody. And before we start, I just want to welcome our newest member, Betty Yee. We are thrilled to have her, our newly installed state controller. I guess it's been a month now, right? Okay, so we give you a little time to get settled before you had to join us here at CalSTRS. But thrilled to have you, and thrilled that you're on Audit and Risk Management Committee. I think your talents and skills and experience will be put to great use here. So we're all very appreciative, and thank you for being here today.
Thank you, Mr. Chairman.
Can I have the roll, please?
Sure. Mr. Boykin? For the Director of Finance, Ms. Ortega? Ms. Higa? And Ms. Yee? Chairperson Rosenstiel, you have a quorum.
Thank you. So first order of business is the approval of the work plan of our agenda for today. All right. Do I hear a motion? All in favor? Great. So our first order then is matter is the approval of the minutes of the November 5th Audit and Risk Management Committee. Do I hear a motion to approve? Second. All in favor?
Control not voting.
Okay. That's approved. Great. And now on to item 3. So this is going to be an education opportunity for us to learn about the accounting and financial reporting for investments. And Robin, I will let you take it away.
Okay. So we'll get seated up here. Okay, so I noticed on the agenda that this is an action item. So I guess our action is to share with you information on this hot topic in terms of audits and risk management. And I do want to let you know that the genesis for this particular conversation came out of the Global CFO Forum that CalPERS hosted in September, and a workshop that my staff attended along with representatives from many multinational pension plans around costs as they relate in particular to alternative investments and the challenges in accounting for those and in the challenges of recognizing them from a portfolio management perspective. And so based on that interest that was spiked in that conversation, we thought that it would be, in addition, based on that and the conversations going out around in the external environment, in the press, around these types of fees and costs and commissions, that it would be a good topic to bring to you. So like I said, although it's labeled as an action item, it really is about sharing information from an expert perspective, not necessarily directly attributable to CalSTRS, not trying to link it that way, but to give you a feel for trends in the industry as a whole and where those trends might create variations in financial reporting and performance management results from investor to investor. So first of all, I want to thank the people who pulled this together. To my left is Shafat Hassan, who's the investment accounting manager in my organization, and she's the one that brought the idea to the table and arranged for our panelists to be here today. That seems like something that doesn't take time, but it takes a lot of time, and so I really appreciate the effort that she put in to make this happen. And then next to Shafat is David Larson from Duff & Phelps, and next to David is Tony Kitchener from KPMG, and next to Tony is Brian Cosgrove from Beacon Consulting. So we hope we have a variety of perspectives and that this will be an interesting conversation. So one of the things that I wanted to make sure that I did in the introduction was to tie this into audits and risks. So we might say, why this topic in this setting? And I think part of the challenge of the topic is that it is not, there aren't requirements for reporting or disclosure that are necessarily clear, which leaves room for what I call creative accounting or creative presentation. And that can lead to a situation where you don't have complete comparability across different presentation formats, whether, again, it's portfolio management or from financial reporting perspective. So again, it's a risk just in terms of seeing where an investor or a manager sits in their comparable environment. I think the other thing is that because there have been discoveries of situations where costs are perhaps overcharged, we know about that. And so the question becomes, how do we make sure we're aware of that potential, and how do we mitigate that from a risk perspective, just in terms of business decision making? And then there are also differences in financial reporting approaches. So is it capitalized? Is it passed through as an expense in the current period? What does that mean? How do people handle it differently, and why? So in terms of tying it into your role as dictated in the charter, those are the things that I wanted to present to you as observations. Again, in terms of the structure that we've put here, again, we're looking at varied industry practice. We want to talk primarily about costs and expenses, and I think those are the most interesting in the alternative investment space. And although we have expert panelists who are members of firms, they're representing their own views. So I just want to make sure that I do that disclosure for them, so that they feel that they're free to share their opinions with you, and you'll understand that that's the context in which it's given. We have come up with 5 questions. I don't think we'll get to all 5. I want to go ahead and lay those out for you. This is really for you. So if you are interested in a topic, we can have that topic occupy the entire time, as long as you see that it's a benefit in terms of the conversation that we're having here. But I will go through the questions that we've come up with, and if you have different areas you want us to try and address, please let us know. I think the value of this is in the conversation, so I hope that you will ask questions as we initiate the discussion from the panelist perspective. They're prepared for that, and that would certainly be my goal. So the first thing that we have talked about is how are investment costs reported? What's generally the industry norm? And how do those vary based on the type of cost and the type of portfolio or investment that they're associated with? And then what are the exceptions or differences? So what's the norm, and then what are the differences? How do those differences or the approach that a manager and an investor take impact performance reporting? So just from a portfolio performance perspective. And how does that vary across the industry, if there are any variations? We're expecting a final GASB statement on fair valuation of investments, and so we wanted to link this in to that potential new standard for us to comply with. And so, again, is there any impact on how we would implement that standard? And with the growing complexity of investment instruments, are there areas in terms of costs, fees, and commissions that would change in those new investment types? For example, if we did direct infrastructure investing, or those moved in a different direction, is there something that would change in terms of the information that we've discussed to this point? So that's kind of our laundry list. Like I said, it's just there as food for thought, and we look forward to your input and suggestions in terms of the direction. So I'm going to start with David in the first question, and then others will chime in as they have varying perspectives. Again, to restate that, how are the investment costs reported? Generally, what is the industry norm for accounting? And how are the various types of expenses treated differently?
So, Robin, thank you. I'm pleased to be here. And again, any question that you have is fair game. I mean, this can be a complex area, and there's often miscommunication and misunderstanding of the same terms. I think as we start to talk about costs and expenses, one of the key places to start is to really understand some of the different types of costs, how they could be treated or how they are treated, and what differences there may be. So in the context of private companies or alternative assets and fund investing, whether it be a direct investment or a fund investment, there's a number of terms that come up. And that be management fees is one. And we say that's often said, all right, we've made a commitment to a fund for 100, we pay a 2% management fee every year for the first period of time. How is that treated? Often, depending on what type of reporting a limited partner does, you or any of your sister organizations across the U.S. or even globe could look at those management fees in a couple of different ways. One is to say that's an expense when it's incurred, because that's cash out the door. But as you think about the agreement, before anybody takes profits from any deals, that money comes back to you. So is it really a prepaid expense that should be there? And how you treat that would impact your percentage return, whether it's a cost or a prepaid cost that comes back. The actual cash flows don't change, but the percentage gain would change. So just as we think about why is this important, it's really, well, if I'm comparing myself to somebody else, are they treating expenses the same way I'm treating them? In other words, are they capitalizing them? If I capitalize them, my percentage return may be a little bit smaller. If I don't capitalize them, I will show a much larger expense, but I'll show a greater percentage gain when the returns actually come. But the cash flows are exactly the same. So that's where often we hear the term that IRR, or internal rate of return, doesn't pay benefits. It's actually the cash return that pays benefits. But IRR does give a true view of cash on cash returns. So that's just a piece. Transaction fees have been in the news a lot. In general, I would make the argument that for the most part, managers try to do what's right. That being said, there has historically been a great deal of gray area in agreements. And sometimes that gray area can be interpreted in different ways. But fundamentally, from again, recording those transaction fees, those fees that are paid to a manager, depending on the agreement, a portion of them goes to offset the management fee. So you could make an argument, okay, a transaction fee, if it's 80% to our good or 100% to our good, actually it's not a big deal, other than, well, is it taking money out of the underlying portfolio company to impact its performance? If it does that, that may not be a good thing, but the fact that you're getting an offset to your management fee could be a good thing. So it's, again, how do I record those? How do I think about those in that context? Things like fund expenses, direct fund audit, and legal costs usually are pro rata shared among all of the members of that limited partnership. So you get your appropriate cost, and that is a real cost to you. Things like, should you vet the valuation? And we're not talking about valuation, but that would be a fund cost. Do you want to have more visibility into valuation? Well, then maybe all of the limited partners are willing to pay a little bit more to have greater visibility into valuation items, but that would be a cost that is a real cost and again, it would impact the overall returns because the overall cash always hits the overall returns. Things like broken deal costs, again, should that be from the management fee, i.e. your partner, the general partner pays it, or should it come from the fund expenses where all the limited partners are shared? And there can be differences there, and again, that's going to impact the overall return. Monitoring fees, monitoring the portfolio companies are similar. So I think when you look at all this kind of bucket of fees, my takeaway is it's important to understand what they are, but looking at them from a purely, well, we paid 2% and that grew into this very large number, but what did we get for it? Well, we've got the infrastructure to invest. We were able to offset other transaction or monitoring fees against that, and we've incorporated that into our IRR, our return, so that we're giving an apples-to-apples comparison. But if we are looking at that if we capitalize those fees, we will have a lower percentage return than somebody investing in the exact same assets, exact same funds. If they expense those fees, they'll have a higher return, but the cash is exactly the same.
Well, I don't know if Tony or Brian, you have anything to add on that one, or if we want to move on to the exceptions or differences?
Good morning, Tony Kitchener. I'm with KPMG, as mentioned earlier. Most of my perspective is going to come from the third-party advisor or the actual fund level, so it might not be directly applicable to what your purview would be, but it's really just a different perspective on how fund level expenses get treated at the fund level. So I guess if I would just kind of reiterate some of the things that David had said related to costs, there's specific gap related to most of these things, and they're prescriptive in that you treat them a certain way. The issue comes when these types of things are subject to interpretation of agreements. When you have your LP agreement, It provides for certain costs that will be reimbursed by the LPs of the fund. Some of those agreements are written very broadly. There's nothing in GAAP per se that would define those costs for you. It's really just what does the manager expect the costs to be that benefit the fund and that the LP should pay for. Now, is there going to be differences on what LPs look at and what they consider costs that the LPs should reimburse? Of course, there's going to be. So really, the issue isn't necessarily there's exceptions. The rules are the rules. It's how they're interpreted, and it's how they're interpreted based on the underlying agreements of the fund. So it's really a focus on how those things are structured, and really, if you can be, upfront in negotiating those terms, you can help yourself understand what's going to go in and what's not going to go into those pools of costs. In general, at the fund level, things like transaction costs are required to be treated as a cost of the investment. So it is effectively, if I was to provide an example, if you went out and bought an equity share and you paid a commission of $10, you would take that $10 plus the cost of the share, and that would be your cost basis. Then you would mark that asset to value at each reporting period. So GAAP's very clear that those costs should be included in there, which at the fund level would potentially impact your, as David said, your returns. Things like transaction costs, as you go down in the kind of, I don't know how familiar you are with the fair value hierarchy. There's kind of 3 levels. One is market priced on exchanges. 2 is there's transactions in the market that you can point to, and 3, there's not a lot of activity in there based on models. As you move down, the types of transaction costs become more broad, and what's specifically related to the asset and what's not specifically related to the asset could be open for some interpretation, and you can have some differences in those types of things that get capitalized to the cost and don't get capitalized based on managers' different perspectives. Again, broken deal costs, and I guess I kind of lump in portfolio monitoring costs as well. This is a big focus of the SEC. The SEC is putting a lot of pressure on the registered investment advisors to better define what those things are and put some parameters around them. And I would assume that as this evolves, there's going to be more specificity in underlying agreements to help people apply what all the parties' understandings were.
So Tony, can you share your perspective on what's driving that? So it's a topic of discussion at the SEC. What prompted that?
Yeah, I think it's the LP community. There's been a lot of chatter in terms of hey, there's a lot of costs that are going into these things. We don't have a lot of transparency into what they are. I think the SEC's picked up on that, and the SEC's driving that bus as well.
So it's really the investor concern that has.
I think it's also the SEC trying to figure out what the investor concerns should be and are. So as the large funds were required to be registered under Dodd-Frank, and the SEC started their inspections, they took I'll say an absolutely fresh reading of agreements, and maybe a very strict reading of LPA agreements. I know that the fee question has been around for 15 years. I've been involved in a workshop here in Sacramento across the river 13, 14 years ago, talking about these exact same fee issues. So I think generally, I would argue most limited partners knew there were gray areas around fees and chose which battles they would fight. As the SEC came in as a new regulator and read agreements for the first time, they asked questions, and that in many ways gave the limited partners some cover to re-ask questions, maybe in some ways where they had negotiated things away, or that they had looked the other way because on interpretations, not if there is some bright lines, but there's also a lot of gray, and in so doing, it's kind of reopened the question. But I just want one other quick thing that I didn't touch on, and I would not characterize this as a cost, but I've seen some interesting articles that would, and that's the amount of incentive fees that the manager gets, the carried interest, their 20% gain. Some would argue that's a cost. I would argue that is an allocation of interests when you go into a limited partnership. So you agreed on who gets what results when you went into the limited partnership, and that is just an allocation of the interest that was pre-agreed to and that would argue is not a cost. But some people would say, well, that is a cost because that's money that as a gain you wouldn't get. The flip side of that, you wouldn't get it unless you actually made the investment yourself. You're using their expertise to get your 80% of that gain.
Can I ask a question? Both with respect to that, as well as the discussion you had earlier about the 2% being, whether it's capitalized or not. But you're saying the cash flow to the limited partner is going to be the same regardless of how we characterize these things, right?
Right.
So what is the distinction you're drawing with respect to how, from an accounting standpoint, we're evaluating the return on an investment, or how, from an accounting standpoint, we're valuing the investment versus how our investment professionals compare investments? I'm trying to, I mean, it would seem to me that from our standpoint, you know, whether we're capitalizing the 2% or not, the question for us is how much money do we put out, cash, and how much money do we get back in, cash, because all we're working with is cash. We have cash to invest and we have cash to pay benefits with.
So I think maybe the easiest way to answer that question is through a quick example, and I apologize for doing the math, but sometimes the math helps understand. So if you say you made 100 commitments, you committed 100 to a fund, and that fund invested in 2 investments, each at 50. So, and you did that, and then you're in that fund for 5 years. So the 2% management fee means you've got a commitment of 100, so you're going to pay a 2 management fee every year. So over 5 years, you will pay 10 in management fees. You've invested 100, and let's say you get capital called for 2 investments, 50 each. So you've now also invested 100 into the 2 investments. So I've invested a total of 110. Let's say in year 5, just to make it simple, I get back the 2 investments, and the amount realized by the fund is 200. Okay, so they get back 200. They sell the 2 investments. So it's a 2x return at the macro level. Well, they take that 200 and they first say, well, we have to give you back your 100 of capital, and we have to give you back 100 or your 10 of management fee. So there's 90 left over. And I'm ignoring other things to make it simple. Of the 90, you get 80%, or $72, and they get $18, 20%. So you've got, if you look, you put in 110, and you got out 182. And if you look, that's the pure cash. You got a 72 gain. If you compare that 72 gain to 100, meaning that you don't capitalize the management fees, you have a 72% return. If you compare that 72 gain to the capitalized management fees, meaning 110, you have a 65% gain. So the percentages change depending on whether you capitalized or not. The cash is identical. The IRR is 12%. So it doesn't, the cash doesn't change depending on capitalized, not capitalized, but the percentage gain would change depending on how you report it, capitalized, not capitalized. The same thing can happen on that carried interest piece, the 18 that the manager got. The 18 that the manager got, depending on how you put that into the model, that could mean that your overall gain was 88% or even down to 56%, just by putting it in where you put it into the equation. So the point is, the percentage gain can be misleading, especially when you're comparing to someone else, if you capitalize and they don't, or they capitalize and you don't. But the IRR will be the same.
We make that decision?
You have made an internal policy decision, and we're talking globally here, so I'm not talking about what CalSTRS has done. There are different funds.
The investor makes the decision, not the general partner makes the decision?
The general partner, I'm just talking about the limited partner. All these cash flows are your cash flows. Their cash flows are going to be something different.
And so we make that decision for purposes of what Chris reports as his investment returns, or what Robin reports?
Their financial statements.
Which? Both?
Yes.
And they're both they're consistent. So whichever way.
So again, I think the purpose here is to identify the fact that there are potentials not necessarily within CalSTRS, but as you look across institutional investors for results for the same action to be different because of the potential for differences in how people look at it from both a performance reporting perspective and a financial reporting perspective. So in terms of specifically how we're dealing with specific kinds of fees, I mean, I think that is a question that is something we can come back to. We're not prepared to answer that directly today, but I think the purpose of the discussion is just to increase the awareness of the fact that as you look at various results, those results are not necessarily comparable without the fine print.
Understood, but I'm still trying to figure out, we make decisions to invest in certain investments because, and then we report the results of those investments. And what I think I'm being told is we can, by how we account for these different elements, we can take the same cash flows and report the returns as either better or worse. And so the way in which we report our returns is not just a function of the cash flows, but it's a function of the way we make decisions about how to treat these cash flows.
And I guess I would say, just from a financial reporting perspective, it's not that they aren't reported, they're just reported at different times in different classes.
Oh, I understand that.
So-
I understand. What I'm trying to say is, we say private equity earns such and such. We say real estate earns such and such, right? And I'm just trying to understand, is that such and such based on decisions we make as to how to treat and when to recognize these various cash flows? Or is this something that somebody else does for us? In other words, how much control do we have about making those decisions so that it affects the returns we report? That's what I'm asking.
The simplified example I gave, you have the discretion. I mean, when I say you have the discretion, you've already made the policy decision at some point on how you're treating those. And you have been, I'm assuming, treating those consistently. But how you treat them could be different from another LP. I think the other piece to that in that simplified example is that if there were transaction costs, that would have driven the 10 of management fees down to 0, and would have, and would have or could have increased the actual cash flow back to you. So that's one of the other pieces where we say with transaction fees, if they're not to your good, they're detrimental. If they are to your good, they may not be detrimental, because it's a much deeper philosophical question as to whether those transaction fees or monitoring fees at the GP level actually caused the underlying company to be worth 195 instead of 200 in my example. Now, the further piece to that even gets more complicated, not to glaze over, is that when you do a deal, when that company is sold, you look at sustainable performance, and those one-off management fees are usually pro forma'd out. So from a valuation perspective, they may not have that big of an input. So we hear about how bad monitoring fees are, how bad transaction fees are. The key question is, what's the net fee you're paying, and are you paying enough to get the superior management from the fund manager and the returns?
So Tony, can you talk?
Can I?
Go ahead.
I think
I'm
Bob's got something to say.
Thank you, Mr. Chair.
Thank you.
Mr. Kitchener, am I pronouncing your name right?
Exactly.
Thank you for coming today.
Thank you.
Just a real quick question. To what extent does GAAP provide some guidance, generally accepted accounting principles, which help us formulate the financial statements that we prepare here at CalSTRS? To what extent do they provide guidance with respect to how these costs are to be reported?
Again, I can provide you perspective on GAAP as it relates to the fund level. I'm not a GASB person, but I can give you kind of a US GAAP perspective. I think, as I mentioned earlier, GAAP has specific guidance as it relates to how to treat costs. So, for example, if we started a fund and we incurred costs to generate documents, subscription agreements, those types of things, lawyers' fees, accountants' fees, those are all organization costs. GAAP specifically says that those need to be expensed as incurred. Now, what's included in organization costs is judgment. So that's where the rubber meets the road. There's guidance that org costs, without exception, must be expensed. What an org cost is, they give you some parameters of it should be directly related to this. It has these characteristics. But could one person look at that and come to a different conclusion than another person? I think that's definitely possible.
And I think there is that GASB standards don't specifically state, but I think in general you would say you would capitalize your cost of the investment, which would be the 110. Where it becomes even more muddled is when you get partial returns through a fund, because is that return a gain or a return of capital or a return of management fees? And depending on how you allocate that, that would impact your interim performance of any LP.
And I guess maybe one other comment on the whole return aspect. I don't know to what extent you benchmark performance of portfolios against other institutional investors. The caveat that David provided is that if you had a decision to treat things a certain way, another institutional investor can decide to treat those a different way. And if you compared returns to returns, they might look different, but cash on cash, it's going to be exactly the same. So it's just something for consideration if you are benchmarking those types of things as well.
So if cash on cash is always going to be the same, and that's basically internal rate of return, why don't we use that as the benchmark for returns?
I think it's the point of cutoff. When are you looking at it? As of what? As of what point in time? It's going to be equal once you close, right? Once you're all the way done. But in those intermediate points, you're going to have different realization of things that are expensed versus things that are capitalized as you evaluate the net asset value of the fund. So it just depends. In the end, it all comes out in the wash. It's just at the various points of reporting that you might have differences.
Well, but Mr. Larson's numerical example was at the end of that 5 years, we had different returns.
Well,
And that would be at the end of a period. If
That's
you
what I'm
now
saying,
said
yeah.
that half of that money came back partway through, was that return part of the management fee? Was it all capital? Was it all gain? And that drives the interim reporting of the results, and that could be very different.
So at year two, when things
So
had gone
internal
out.
rate of return doesn't work at year 2.
Correct. It
would
really only works
at year 5.
to the equivalent at year 5.
And in many fund situations, even though we have a 10-year fund with a 2-year extension, it gets extended to 15 years or 18 years, and it seems like the fund never dies.
So maybe, Brian, you can help us, because one of the things that we had talked about as well is how does the approach to cost treatment, and this may be on an investment by investment basis too, so the legal parameters around the limited partnership may establish some of this as well. But how does that impact portfolio reporting, or what are the nuances in portfolio reporting, and how do people get to comparables? I mean, is there a way to get to comparables? Is there a happy ending to that?
I'm sure that if I could offer a prescription for how to get to comparables within the time remaining, we can memorialize that and publish it for the whole world, because it's quite a challenge. And I think David did a real good job of describing sort of the ways that similar cash flows can be represented differently in the area of performance reporting. And also I think it was very good that we pointed out sort of the timing aspect of when you're looking at year 1, 2, and 3 of an agreement, how it can have the decision to capitalize or to realize as an expense has a significant impact on what the numbers look like early on. Maybe the best place to really talk about, provide you some additional insights is, you talk about the decisions to how to treat it. What we've seen with a lot of the clients that we work with is really, really looking at asking themselves the questions of, do they have the transparency into the fees that they're paying and what functions or what components are made up of the fees that are being paid, and when money's being returned, what exactly is the intent of it, and understanding the components thereof. The transparency is the key word here, and the dialogue is taking place with the SEC and the LP advocacy groups and firms and other institutional investors, and really looking at these relationships. And what we see is that some of the sort of larger institutional investors really using their size to lean a bit on their partners to demand maybe a more granular set of data in their reporting, a little bit more frequent reporting, so that when you do come to make the decision of how you're going to recognize a specific cost, you have more information to support that decision. So let's just say that you've pressed a particular institutional investor, has worked with their partners, they're really receiving the transparency they need to understand those costs, and those money's being sent this way. The next step in this journey, and the other question that we see our clients asking ourselves, is how do we make it comparable? What I think what we've seen with the clients that we work with, we've really seen that what they have in hand today is a result of many years of maybe different negotiations, different fee structures being put in place, and evolution of their standard LP agreements. So many clients find themselves today where the terms across these different investments are not similar, and they're not easily comparable. And again, so what you're left with is, a very much of a challenge in the performance reporting department to really maybe calculate those initial IRRs on an individual basis, but to also normalize them in such a way that can make them comparable, so that you can look at many different general partners and say these investments really had the same exposure, they really had the same a lot of similarities in terms of their strategic objective, but they're returning a different level of IRR. Is that because of a variance in the fee agreements that we accounted for differently, or are they truly one outperforming the other? So really, it's in those two areas that the demand for transparency, and then the effort to sort of bring those together onto a common set of definitions to allow them to be comparable, allow you to analyze this from a general partner's perspective, an investment strategy perspective, or an asset class perspective.
So, the next area we had talked about bringing up for discussion was, excuse me, I'm sorry.
Forgive my rudeness.
You're not being rude on. Just didn't see.
So you mentioned one of my favorite words, transparency. So from a board's perspective, one of the things most certainly the board is interested in is the transparency of agreements that are inherently non-transparent with respect to the way they're arranged and managed by a GP with several LPs, general partners, and several limited partners. Where do you, notwithstanding any action by regulatory bodies such as the SEC, where do you see the trend in that going? Where do you see the pressures coming from? And what do you see the future holding with respect to being able to peek inside some of these things?
Well, I do think, I know we're not going to talk about regulatory, but I would say that regulatory is very much casting a shadow that is seen by all. So maybe there's not the direct applicability in this area, but they see a shadow approaching. But to answer your question, I think the trend that we're just starting to see is that those institutional investors with the size and book necessary are able to start influencing their future agreements and really building into their limited partnership agreements. They defined a standard for themselves that they want to work around, and they put that standard forward as they enter into these agreements and say, if you want to do continued business with us, here are some terms that we really need to kind of rally around. Now, I wish I could say that that's that's all it takes. It then comes back to a negotiation process and the leverage that may or may not be there. But that's certainly a trend that we've just started to see amongst the clients we work with.
And that's something that in the group that we've been party to, both at the national and international level, it's that standardization for reporting and transparency that's really been the focus. Can we get a data set back that lets us interrogate this in a way that we have more understanding, not only at the point of agreement, but also in the follow-on reporting, that we are getting data that we can use to assess what's actually happening?
And I think that it is a difficult question. I mean, because by definition, there's not full transparency. Part of this is you invest with managers that are solid citizens, and most, I would argue, are. But even if they are doing their best to be solid citizens and to interpret the agreement fairly, there are some things that are almost inevitably stacked against you, or limited partners in general. Even though, because you say, all right, they're trying to do the right thing, but there's a gray area in the agreement. Well, the auditor comes in to try to make sure they're doing the right thing. But when the auditor comes in and looks at that gray area in the agreement, they will ask legal counsel, okay, how do we interpret this? But inevitably, they ask the general partner's legal counsel. They don't ask the individual limited partner's legal counsel. So by definition, there's a slight bias towards the GP. So the more clear your agreement is going into the deal, the better it is to monitor transparency throughout the life of the partnership.
So we're through one of 5 questions, and we're at our 45-minute limit, just about.
I want you to
So
feel,
just-
I actually want you to know that you're through 3 of 5 questions.
Oh,
which
okay,
is what
great.
the benchmark was going into the discussion. So we have achieved our benchmark return. We just
Excellent
wanted to
job.
make sure that we had fodder for additional conversation if we needed it. So I
No,
don't
I
know.
don't want to, we don't have to stop yet. I think we got a few more minutes perhaps, but I want to be clear that we do need to wrap up.
Yeah, so
Too soon.
I'll leave that
I
to
don't
the.
know whether, I haven't gotten any questions from committee members, so I want to make sure that if people do have questions that see, we do have a question. Grant.
Took the bait. So just big picture, one of the takeaways for our perspective as a board or as this committee is that costs matter. How we allocate costs can matter in terms of looking at performance. I mean, in addition to the transparency piece, but that's why you've queued up the discussion. That's hard. Okay.
I think they absolutely matter. And again, I think there's some real cost impact depending on whether things net against the GP fee, right? I mean, so depending on how that's structured. And then I think they matter from a comparability perspective a lot. And then I think on an ongoing basis, they matter because you want to monitor behavior or actions.
And I think that also there's a trade-off, because you could say, well, we need to drive our management fee down. That's a big part of our costs. But the manager needs some level to be able to run their business. So what's that? But so if taking my simple example again, if you were to drive that management fee down to 1% and keep all the facts the same, but in exchange for the 1%, let's say you had to give the manager a 25% performance fee or 25% carried interest, you would actually end up with only $71.25 rather than the $72 gain, because of the way the math works and the way it works. So even though you paid less management fees, you would, so you're and the IRR one may be slightly better, but you would actually end less actual dollars of gain to pay benefits.
Thanks.
I think just one other comment on transparency. I think it also kind of goes back to where we're at in the cycle. I think there was a point where LP investors were at the precipice of take it or leave it. Right? GPs had all the power. There was plenty of money to raise right before the financial crisis. So agreements were signed just to get money out and invested. I think now that we've kind of gone through the financial crisis, people have stopped and looked and said, did these all make sense? There's a lot of fallout from all of what happened through the financial crisis. And I think just putting some discipline around that on a perspective basis is something to consider. So.
And maybe a final comment, coming back to the transparency. If you have a manager that for whatever reason you think is not acting well, you can work with the other LPs to go in and look at the books and records. We've seen that done before. You have access generally through Delaware partnership law to get to the books and records. You work through the advisory committee, get there. In most cases, it can be costly to get somebody to help you through that because it's very complex, but generally it pays off in doing it.
I think, the concern is that what we seem to be doing is we're learning about our concerns because the New York Times points them out to us. And rather, so there is definitely a lack of transparency that the LP community maybe hasn't even been aware of because we haven't even been aware of what we haven't been told. And that's the question that it seems to me we need full transparency. Then we can judge whether these are fair fees, whether we're getting value for these fees. But the wrong way for us to approach this is to say, well, yeah, net of all these fees, we're still getting a good return, so let's turn a blind eye to it. We have a responsibility because this is public money, not to turn a blind eye to it and to demand as much transparency as we can get. And then we can judge whether we think those fees are justified given the returns and the risks we're taking in getting those returns. But, so my concern is how do we know that we have transparency? And I don't know how we get there. But so far, well, Mr. Larson, you're saying that our general partners are upstanding citizens, and I don't doubt that. They don't seem to always want to tell us everything.
Hence the name private equity.
Well, but we're their partners in
Yeah,
private
absolutely.
equity.
And I think,
I don't think that's what private means.
and I agree. I'm being facetious. I think that in many ways, part of it is you have very competent people on your staff making these investment decisions and monitoring these partnerships. They often have a great deal of transparency far beyond what the New York Times even can comprehend. And they're managing in a multitude of things looking at that. So I think in general, the transparency can be there. It is incrementally looking at how can we improve our practices to make them even better, and in monitoring our investments, in structuring our agreements, and then in looking at different things that pop up. Most of what I read in let's say in various publications, I won't pick out the publication you named, has a modicum of truth combined with a lot of conjecture and some misinformation.
And to perhaps provide some comfort, I mean, it has been and continues to be a topic of discussion from the financial reporting perspective amongst the global institutional investor community, particularly based on pension plans, because we all recognize that we're not getting the kind of granular detail that we need to be able to interrogate things on a consistent basis. And so, that is the nature of the discussion. Is there a way to create that transparency through a reporting standard that we could all use?
Thank you. This is very, very useful. Appreciate it.
Thank you.
Thank you for coming today. So, our next, get to the agenda here. Item 4, the External Auditor's Report over Financial Reporting and Management Letter Items Status Report. Larry?
Good afternoon, Mr. Chair. Is that on? Nope. Good afternoon, Mr. Chairman and members of the committee. I'm Larry Jensen, your Chief Auditor, and pleased to be here with you today. This particular agenda item number 4 is an information item, and it's a status report on management's progress towards implementing the recommendations that were included in Crowe Horwath LLP's report on internal control over financial reporting and their management letter that was in connection with the audit of last year's financial statements of CalSTRS. And although that letter is dated June 30th of 2014, the results of that were presented to the committee this past November, had an opportunity to review these. And to date, there's 3 recommendations now that we're showing in the attachment here that are fully resolved, and management continues to make progress on the remaining 6 unresolved findings that really focus on improving internal controls over member data, as well as our financial reporting. And all of these findings and the current status are outlined in attachment 1 of this agenda item for the committee's review. And audit services role as we continue to monitor management's progress towards implementing these recommendations, provide a report to the committee periodically, but at the end of the year, when the financial statement auditor comes back and performs that audit next year, they will take kind of a deeper dive and a look at these and determine the final resolution and disposition of the audit findings, whether they would close them or continue to report them. So that concludes the information I'd like to share on this, and happy to answer any questions that you might have.
Any questions? Bob, do you have anything to add?
Surprisingly, Mr. Chairman, I know, I do.
That's why I asked.
Thanks, Larry. I want to thank you for the format of this report. I think it's very useful for the board to see what the findings were, to be reminded of them, and for those findings to be brought back with the intent of keeping the board updated on what was found during the audit and the status of those items. So thank you for this report. When you say that an item is resolved in whole, whose opinion is that, and do you concur with that opinion?
That's a good question. The responsibility for these findings were issued by the external financial statement auditor, Crowe, who ultimately has the final determination whether the actions taken by management fully address the risks and implement the recommendations as outlined in the finding. And so they typically will do that when they conduct the next audit. We do not provide any level of assurance on that. From our role from internal audit, we can assist management with implementation of the recommendations, or perhaps help them address new ways of implementing, addressing the findings, I should say.
Perfect. I just wanted to clarify that you, as the auditor, weren't taking responsibility of ascertaining whether or not these are resolved, but rather that was the person who sort of came up with these opinions, which is the auditor.
Exactly. A little bit later, we're going to discuss some internal audit findings where it's a little different scenario, and we'll discuss that.
Well, great. Thank you.